Hello, everyone. Just gonna get started in a second here, just setting things up real quick. There we go. I'm getting my camera finally next week. I've been waiting for like 3 weeks with all of the delays because of COVID. So I will finally be able to stream using a camera. There we go. All right. Perfect. So welcome everyone to today's session on, investing during different types of recovery. So we'll be talking about this most recent K type recession, if you will, that we've seen. And we'll talk about, how does it, how does this bode for 2021 and beyond? What should you be investing in? What should you stay away from? So let's get started. So let's look at the very, very basics first, right? So what are stocks? Well, stocks they represent underlying businesses. So whenever you're buying stocks, you're becoming part owner in a business. If you're buying individual stocks, if you're buying ETFs or mutual funds, you're buying a subfraction of a fraction of a business, basically, right? So at their core, stocks represent underlying businesses, right? However, just because stocks represent underlying businesses and part ownership in those businesses doesn't mean that stocks and the underlying businesses will necessarily always fluctuate or move in the same direction. As a matter of fact, in many instances, a lot of very hot and trendy startups that don't have any revenues are just massive money-losing operations in terms of, from a profit point of view. Their stocks might still climb exponentially, even, 5, 6, 10 years in some cases after a certain online company was launched. And sure, a lot of those companies eventually start making money, and some of them, such as Facebook, such as Google, etc., become ridiculously profitable at some point or another. But for every Google, there are probably, between 5 and 20 other companies that try to do something similar and have not made it quite as far. So there's that, added risk. So all of this to say that stock prices can deviate from the underlying businesses. And a lot of times there might be some positive or some negative news, which will make the stock price of a given company drop substantially, despite the fact that that company actually could potentially be making a ton of money in the meantime. It's just that there might be a lot of fear because of something happening. So just keep that in mind. Stock prices don't necessarily move in the same direction or at the same pace as the underlying businesses, companies, etc. Because again, what are businesses, right? Businesses are an amalgamation of people that have a given goal, whatever the company's goal or company statement is, to produce product X or to provide service Y, right? So stocks and businesses are impacted by factors, sometimes the same factors, differently, other times by different factors to different extent. For instance, you might have certain issues in the broader economy that will make that particular business be a lot less profitable. But that doesn't necessarily mean that the stock price will instantaneously reflect that same amount. Sometimes there's an overcorrection. So you have to realize that there's this dissociation both on the upside and the downside between stock prices and the underlying businesses and how well their employees are paid and how well the business is doing overall. Now, there are many, many, many different factors. And again, if I was to go into every single one of these today, we would be here for like an hour. I'm trying to make these shorter. So I'll be addressing these in future sessions when we talk about different things. But one of the primary drivers of stock prices tend to be interest rates, specifically low interest rates. I'm sure you've heard either me say or maybe on the news in the past that whenever, money is cheap, i.e. interest rates drop, people are a lot more incentivized to borrow money. And as a result, then once it's a lot cheaper for you to borrow money, then you're more likely to perhaps try to buy a house that otherwise you wouldn't be able to afford if interest rates were at, let's say, 15%. You might be interested in borrowing money at 2, 3, 5% to invest to be able to get 7% plus on your investment portfolio. Whereas again, if interest rates were 10%, that wouldn't really make much sense, right? So interest rates are a definite massive driver, and a lot of people are concerned that in 2020, since we have had a pretty decent, not every single stock market has performed decently, but a lot of them have done quite well, and I'll show you some examples on the next slide. they're worried that maybe this was overhype. Maybe the reason stock prices went up is because of this massive government stimulus, not because those companies are necessarily doing well and the economy will be recovering. Well, again, that requires a bit more to unpack there, but it's a little bit of both. I would say it also depends on employment numbers, right? Obviously, for the underlying business, if people are if the business have to cut if a business has to cut its employees, that's actually initially that's a good thing for the business. It's terrible and it's devastating for the employees themselves, but for the business's bottom line, that's a good thing. If you're able to operate with 10% fewer employees, yet deliver the exact same quality product or service, that's actually a net win for the company itself. So again, what's good for you and me as an employee if you were to work somewhere, and what's good for your employer are not necessarily always the same. And then what's good for the stock is not necessarily always the exact same as well. So again, we have had some rebound in employment, but for specific industries, things haven't looked great in 2020 and likely will take a while to recover in 2020. I'm thinking, for instance, the hospitality industry. So, Airbnb might take a little bit of time to get back up and running, probably by the end of next year, in terms of actually seeing a significant increase in bookings. Same thing with all the large hotel chains, any form of travel, anyone in the travel industry, whether you're looking at airlines or whether you're looking at cruises or you're looking at, massive, package deals that you would typically have provided to you by websites such as Expedia, etc. Now, obviously, it also depends on GDP. So, if the gross domestic product of a company of a country is increasing and the company itself is contributing to that because the company is growing, that typically has a positive impact on stocks. But again, just because something is positive for the economy doesn't necessarily mean it's good for stocks and vice versa. And again, the various stimulus packages, this sort of goes a bit hand in hand with what we were talking about here with interest rates. A lot of times you will have interest rates being to some extent massaged or manipulated depending on your take, at the same time as companies or perhaps individuals might be provided with various forms of either stimulus or emergency packages because, again, the economy had to shut down for some time. Now, so key takeaway here is asset price recovery, so the recovery in price of stocks, is not the same. It doesn't occur at the same pace as economic recoveries. Typically, economic recoveries can take substantially longer because, again, stocks, as Benjamin Graham said, short term, the stock market is a voting machine. So basically, people try to vote, try to say what they think something is worth. Some of them might be right. A lot of them are typically wrong. And then the market will sort itself out long term. So long term markets go up by about 73.1% of the time. In terms of if you're looking at the market basically ends the year higher 73.1% of the time compared to what it started off. So you have a pretty good bet of actually making money if you're investing in a diversified portfolio on any given year. You might not make as much money if you were to invest in the hot stocks, but overall. Now, just because, again, markets are recovering doesn't necessarily mean that the underlying companies are recovering at the same pace, and especially doesn't mean that the people that used to work in those companies are able to still do so at the exact same rate. So that's something very important to look at. Again, stocks can be bought and sold with one click, right? Whereas, good luck trying to reverse a company's terrible quarter in sales with one click, right? Whereas if you want to buy or buy more of shares of that particular company or sell off all of your shares because you think the company is doing poorly, it's literally a click away on your app or on your computer. So because of this, asset prices move a lot more erratically and can recover a lot faster, at the same time can also crash a lot faster than the economy in large. So let's very quickly look at some of the more common types of recoveries. Now, obviously, there has been and there will never be a shortage of pundits and experts and analysts trying to forecast the future, right? And to some extent, we're trying to do this in this video right now as well, right? So what many many of the optimistic pundits were calling for back in March and especially April and especially in early April. Keep in mind, the U.S. and Canadian stock markets have reached their bottom on March 23rd, 2020. And since then, they've been pretty much on a climb, a steady climb, especially in the US. Again, in Canada, it's been a bit slower, but the Toronto Stock Exchange has been recovering as well. So the optimists among them were forecasting basically a V-shaped recovery where, basically the market had been moving higher over the last little while. It crashed, and actually, as a matter of fact, it crashed probably even more severely than this. And then they were forecasting a relatively quick reversal. Now, depending on which market you're looking at, depending on what index you're looking at, this pretty much has happened for some indexes, for some companies, for some sectors. So for some sectors, we have seen a V-shaped recovery. Now, the slightly more pessimistic view of some of the pundits back in earlier this year was that we would have a U-shaped recovery. And it's literally, you get the exact same thing as we saw up there. And then you have the crash. But then instead of reversing right away, it would take quite a bit longer. So you would have this sort of a recovery that eventually, instead of it taking, half a year, because again, we've seen the biggest stock market decline and the biggest recovery on record this year. Again, depending on which markets you're looking at, but if you're looking at specifically the US one, that's the case. So they were forecasting this sort of, yes, sure, we'll recover, but it might take between, let's say, 1.5 to maybe 3 years to recover. Again, for most companies in the US especially, this hasn't really been the case. A lot more of them are either a lot more flat than this, or again, we're not, not enough time has passed yet, but quite a few of them, especially in the tech sector, have been recovering a lot faster. Another relatively pessimistic view was this W-shaped recovery, which again, you would have the regular increase that we've seen before the high that was previously reached on February 18th, both in Canada and the US. That was the previous high of the markets. And then you would see the same crash, but then you would have one attempt at recovery, and then maybe some other bad news will come along, right? And as a matter of fact, back on March 26th, in one of my earlier videos, when I kind of took quite a bit of time discussing some of the modeling for COVID-19 and some of the potential economic implications and so on and so forth, I was saying basically on March 26th, which was 3 days after we had seen this reversal, I mentioned that this might very well be the bottom, but because there's so much unknown, it wouldn't be outright, it wouldn't be completely abnormal to see another reversal. Now, whether that reversal or that pullback would happen, up here and then you have a small pullback like this, or whether the pullback would be a genuine full-fledged kind of W recovery, or basically you maybe go back up 50% or even 100% and then you have a second massive crash, that again is still up for debate. Not enough time has passed. So this, for the broader stock market, is still a possibility. We might see a decline. Right now, most of the stock market, especially if you're looking at this at tech stocks, at US stocks, they've pretty much followed the V. It's not really a U yet. So this could happen, right? Right now, we've heard of this newer, slightly more virulent strain, slightly more contagious strain of COVID-19 that was found in the UK back in September. They only really started reporting on it and worrying about it last week. And then just yesterday, they announced that secondary and tertiary strain that was reportedly found also in the UK, potentially coming from South Africa. Yes, so it's to be expected that we would see mutations of COVID-19. The good news is, as long as the mutations aren't too big, the vaccines should still be equally or just at, pretty much 99% just as effective as they are with, with the original or more common strain, right? So that being said, if, God forbid, a significantly worse strain were to emerge X number of months down the line, I wouldn't be surprised to see another leg down. But again, right now, unless that happens, the markets are pretty much on a romp back up. And as the economy recovers, the real economy recovers, that will be just that much more positive for stocks. So, this might not materialize. The W might not materialize, again, unless we get some massively negative information about COVID-19 and a new mutation or a new strain of it. And then the really pessimistic people out there, and there's always some that say, this is the end pretty much. We're forecasting an L-shaped or even worse case scenario, or an even worse recovery. So what is an L-shaped recovery? And I'll show you. We'll be using the Nikkei, so basically the Japanese stock exchange as an example. They've been more or less in sort of a protracted L for the last 31 years to the day. Literally, the last high, the historic high of the Nikkei is pretty much in the last week of December 1989. As a matter of fact, if you're looking at which week it happened, it was the week of December 24th. So literally 31 years ago to the day is the last time the Nikkei was over 31 or thereabouts 1,000 points. Right now it's around 26,000 and change. So it has been recovering, but you will see long term it looks a lot more like an L that sort of is starting to try to be a U. But so that sort of thing can happen. Not very likely for the North American stock exchanges, but so that was the pessimistic view. So the pessimistic view is like, okay, we had a great run up until 2019, early 2020, and then you see this massive drop, and then just basically this. Right, so it looks much more like an L. And those that are really pessimistic were really forecasting something even worse, which looks a bit more like a lightning bolt. So you have this increase, then the flatlining, and then potentially even a secondary drop further this way. So again, those more negative options seem very unlikely at this point in time. So right now, this is what has happened to most of the markets. To most stocks in the tech market, in the US market. The W could still occur. Now, that's if you're focusing on those stocks. If you are trying to not only focus on stocks, but you're also trying to take into account the real economy, then what we have actually been seeing, and for some stocks as well, if you're looking at all sectors, then it's actually more of a K-shaped recovery. Okay, so before we get to the K and what that means, let's very quickly look at the L, and I'll basically cover each one of these with real examples. And the really fun thing is, again, this is the first link down below in the description. So this looks at the Nikkei 225. So those are the 225 largest companies on the Japanese stock exchange, on the Tokyo Stock Exchange. So you can see basically it was 38,000 or thereabouts points, and it was reached on let me just pretty much on the right around the 24th, 17th, 24th of December 1989, 31 years ago. And now again, long term, you can see this is pretty much what that looks like, right? What an L looks like. It drops, and I mean, sure, like there are sub-variants within that protracted L, but you can see, right, from up there, you have fluctuations, but it's just barely now starting to kind of form a very long-winded U. But for many years, for the last 20 years or so, for the 20 years or so following the crash, it was pretty much a protracted L. Now, obviously, if you were to zoom in on any one of these, so let's say if you're looking at what happened in Japan right after the .com crash, right, the 2000 crash, this looks more like a U, right? So this would be a U, right? It took from 2000 to about 2006 for a recovery. So within this protracted L, you have an example of a U over here. You also have an example of a W-shaped recovery right over here. Like if you're taking into account, let's say if this is your timeline that you're looking at over here in the early 90s, you have this sort of W pattern that occurred, right? So if you're focusing in on just a few years at a time, you might see different forms of recovery, right? So long term, it might be an L. Shorter term, you might see a V, you might see a W, and so on and so forth, or even a U, as I showed you, right? So again, what has happened with the Canadian markets? Well, again, if you're just to track this simple ETF over here, if you're looking at year to date, right? So it's not a perfect V, right? But if you're looking at, within, and this is within a few months, right? If you're putting it on the 5-year scale, right? It doesn't look like a great V, but again, the letter this resembles the most of is a V, right? But again, this is the the Canadian market, if you were to take subcategories, sections of the market itself, then that's quite different, right? So and that's where you get this K. So if you're looking at the broader economy, if you're trying to look at all sectors, not just the average of everything, if you're looking at specific sectors, again, you're looking at air travel, the air travel industry, the hotel business, et cetera, et cetera, et cetera. A lot of those businesses, a lot of those companies haven't been recovering, are very, very slow to recover. Yes, some of them might be in the U, some are actually still dropping in value as we're speaking. Sorry, I still have a bit of a cold. By the way, I got tested last week. It's not COVID, so yay for me. But yeah, this has been pretty nasty cold, lasting quite a while. It's been about a week since I had it. So let's look at what the K looks like. This is the second link in the description down below. So here specifically, I'm looking at, I'm just picking here, and obviously I'm cherry picking my examples, but to prove the point, right? To drive the point home. Here's in blue is Amazon, in red is Boeing. I don't think any of you are surprised that Boeing is not doing so great right now, with the vast majority of their planes not really flying right now, and obviously airline industry is not ordering a ton of new planes for the time being, because they're not really sure what's going to happen to their business model in 2021, 2022, 2023. Yes, sure, we'll start seeing more and more people be able to travel once enough people get vaccinated, et cetera, et cetera, et cetera. But no one knows to what the pace will be like. As a result, those companies, those industries are going to take quite a bit longer to recover. So this is the K, right? It's starting. There's this divergence, this branching off, and specifically if you're looking at the real economy with people, in the real world, other than just the stock market fluctuations. A lot of people have yet to regain their jobs, or at least have yet to regain their hours, right? And the people that were the most impacted were the lower income individuals, blue collar workers, people working in the service industry especially, which again tend to be slightly lower income or lower paid jobs overall, right? So yeah, this is the unfortunate thing of basically if you're able to invest. Or if you're working if you're lucky enough to work in an industry where you're able to work from home, you won't really see any significant decrease in your salary. As a matter of fact, savings rates have been going up in Canada on average. Right now, it's about 14%, which is 5 times as high as the level before COVID came along, right? So. Let's and just to show you that it's not just Boeing, it's that entire. So let's see. I'm trying to remember the air. I think it's that beak. It's on the Berlin Stock Exchange, if memory serves. Let's put that one. So this is Airbus in green, right? So you can see it's tracking pretty closely. Let's put it on the 1 year. There you go. If you put it on the 1 year, it's pretty much indistinguishable performance-wise from Boeing. So Airbus and Boeing, the two largest manufacturers worldwide of planes. Not surprising that they're taking much longer to recover. And then obviously in between, if you were to add kind of big staple companies, like for example, if you're looking at Coke, right? Coca-Cola company, let's put it in black. There we go, closer to the color of their drink, right? So they've been obviously a solid company, and it's been recovering, but you see it's kind of a very protracted, initially a V and looks more like a, sort of weird U shape long term, right? Because it's very protracted, very slow. Whereas other companies, especially the tech sector, such as Amazon, have been doing really, really, really well, right? So in summary, as I said, if you were to look at the average in the US, on the US markets, because they tend to be quite focused quite a bit on tech and on banks, it's close to a V. We might get a second decline if bad news come along and create a W. But right now in the real economy, it's more of a K, right? So the question is, how should you invest? What makes the most sense to invest? And yeah, so here for your reference, so again, the K is when you're starting off from somewhere, and then some sectors go, and you have the decline, and some sectors recover right away, whereas others after the decline just keep on going lower or barely recover at all. So it's sort of a weird looking K, but yeah, the letter that looks like it the closest is potentially a K. So What should you be invested in? So different sectors are impacted to different extents by the same events, as I've said before. So stick to the basics, right? That's usually what works for most people. Now, this doesn't mean you shouldn't try a few things, and we'll look at 2 examples here. But for the vast majority of people, sticking to the basics tends to work in any form of market, really. And there's no real reason to believe that this won't be the case going forward, regardless of if the V completes as a V, if we see another leg down at some point or another, if you get some bad news at some point and it becomes a W, or if the K, that is the real economy, takes longer than expected and then hoped for to recover. So for the vast majority of people, a balanced and diversified ETF portfolio is probably the best place to be in, right? For most people. Now, there are exceptions. If you understand what you're doing, you understand the risks, you're okay with the risk, you're able to stay invested, stick with that particular investment through thick and thin for longer periods of time, and you don't mind the increased risk, there are a few things that might be worth looking at. But again, if you're the average person who has a lot of other things to already worry about in your life, probably just sticking to a balanced and diversified portfolio is probably best for most people. Now, notice how I underlined the word balanced. Now, tomorrow you have a special little treat. It's a short video that I'm just finishing up editing tonight, that I'll show you why balancing and rebalancing at least once a year, why that makes a humongous difference. Because by being diversified, I think most people understand that, if you were to invest, 10% of your assets and, you split it, so you have 100%, let's say you have $100, right? If you're investing $10 in each company, right? 10, right? So you invested $10 in 10 different companies, your likelihood of losing money is lower than if you're just gambling everything on one company, right? So the diversification is pretty easy for most people to understand. The balancing part, that's what most people get wrong. So you have to rebalance, because if you just stay invested in those 10 particular companies, you will fare a lot worse. So again, I pretty much finished up the video. I'll be posting it tomorrow. So that's your little Christmas present from me. Very short video. You can watch that. So very important. Remember, speculating / gambling is not the same as investing and is not the same as saving. If you need money for the short term, few months or a year or so, save it. Even with these ridiculously low interest rates, try to find something where you can get around 1 to 2% per year, and that's pretty much the only thing you can do, unfortunately. If you absolutely need that money, to pay next month's rent, there's no one reasonable would take that money and gamble it on Bitcoin, for example, right? If you're trying to look at long-term investing and you're looking at more or less predictable, rate of return of around 7% or thereabouts per year, then investing in balanced and diversified portfolio is probably the way to go. If you don't mind taking slightly higher risks, then potentially speculating and gambling a little bit on some things, such as certain cryptocurrencies. Again, stick to the big guys like Bitcoin, probably, or something slightly less risky. If you were to go in full, innovation ETF like the ARK ETFs, which I'm working on a video coming up for next week on that one. So check back soon. So if you feel the need to speculate, for most people, again, there are exceptions, but for most people, most licensed advisors typically recommend don't speculate with more than 10% of your portfolio. Again, for most people. Maybe you're someone who doesn't mind the risk. Maybe you're someone who has a ton of money saved up for emergencies, and you're like, you know what, this $5,000, $10,000, $1,000, whatever, $1,000, whatever it is, I don't mind if this goes to $300 that I'm losing, 70% of it. I'm okay because I can stick around and it'll eventually potentially might recover, right? So if that's you, then that might be worthwhile, it might be worthwhile looking at higher risk propositions. But again, for the average person, balanced and diversified portfolio, I know, sounds boring. It's super boring, but it's something that will definitely beat savings any day. Sticking with savings is a losing proposition right now. If you're looking at, 3, 4, 5+ years time horizon, no reason whatsoever. Uh, oh yeah, no. So great. So actually, yeah. So so yeah, great comment. So you should make a video about how to rebalance your portfolio with Excel. So yes, I'm working on that one. The one tomorrow, I'm literally going to show you very briefly why and to what extent rebalancing can change the world. Like you might have a diversified portfolio, but if you don't rebalance, you might end up making zero money after X amount of months if you get unlucky enough and a certain pattern repeats. Whereas if you, with rebalancing at least once a year, you stand at making a lot of money. And again, we'll see literally tomorrow, short video. But yes, I definitely will have a longer one. And by the way, since we're talking about portfolio balancing, and I've been getting a lot of emails from my students about what should they invest in the new year. So what I decided to do is literally starting on the first, every single Wednesday in the new year, Wednesday evening, I'll be posting one video about what I'm going to be. And again, I'm just going to start a very simple balanced diversified portfolio using a handful of ETFs. So relatively simple, relatively, and those of you that are interested in slightly higher risk stuff, you can play around with, 10% of your money. And literally every single week, I'll be investing a tiny amount. So basically, I'll be investing roughly $100 a week. Okay. So $100 a week. And I'll literally show you what I'm like on Wednesday. I'll tell you tomorrow morning, this is what the portfolio looks like right now. Tomorrow morning on Thursday, that way you can do it at the same time as I am. This is what I'm going to be buying with this $100 per week. So, again, I'm not a licensed advisor, but I will literally show you what I'm going to be doing. I'll give you all the links to all the background information in terms of the theory behind it, why it's likely to work, and then we can compare that to something more actively managed. We can pick maybe a hedge fund or a bunch of mutual funds and see if that simple approach can actually beat them once you account for fees and etc. So I'll be doing that with real money next year. Again, every Wednesday evening, I'll be posting one video of the stuff that I'm going to be buying the next Thursday morning. You can invest along if you want, or at least, just watch those. Could be fun. They'll be short, less than 10 minutes or so. Anyway, so if you feel like you need to speculate, do so with 10% of your portfolio. Now, I've also been getting a lot of emails about cryptocurrencies, right? So it's all about, have you seen the crypto market? Should you be investing in the market? So again, when it comes to cryptos, that's speculation. I don't mind speculation if you understand the risk. So if you're okay with the ridiculous fluctuations, that might be something for you if you have, if you don't have debts, etc. You're not, remortgaging your house, basically, is what I'm trying to say. So let's very quickly here. This is link number 3. Let's very quickly look at CoinMarketCap and how crypto has been doing lately, and why I keep on saying it's speculation. Which again, I'm not trying to say speculation equals don't touch it. I'm just saying speculation equals much higher risk. So be careful. That's all I'm saying. And again, it might not be for most people, but for some, if it's okay for you, then yeah. So anyway, so if you were to look at cryptocurrencies, the key thing to be very careful about is where are you buying your cryptocurrencies from? What market are you using? What brokerage / where are you exchanging? What exchange are you using? How safe is that transaction? Because the problem, unfortunately, even in 2020 and soon to be 2021, despite the fact that cryptocurrencies have been around at this point for about a decade and a half almost, it's not really regulated, which is a good thing to some extent, and to many, that's a massive, it's massively appealing. But the downside of it not being regulated is sometimes if you're just opening an account without researching what exchange you're actually opening an account with, or what brokerage you're opening that account to buy whatever cryptocurrency is that you're trying to buy, if they're a less reputable one, they don't have proper safeguards put in place, you might end up literally losing all your money, not because you bought the wrong type of coin, but because you get hacked or the exchange gets hacked, and then your cryptocurrencies go poof, right? So that's the added risk, which already to something that is ridiculously volatile, it doesn't help, right? So the reason I'm showing you this here, so yeah, stick with probably Ethereum and Bitcoin. Primarily Bitcoin, I would say, because the other ones, yes, sure, you might make more money, but this becomes that much more risky. Look at the 7 days. So how have these cryptocurrencies fared over the last 7 days? This is just to show you how much volatility there is over the last 7 days. Ripple here, right? Ripple is the fourth largest cryptocurrency currently by market cap, right? 11.89 billion US dollars, by the way. So that's about what, 15 billion Canadians roughly, right? That's $15 billion. Like, imagine a $15 billion Canadian company. That's a massive company, right? The price of Ripple has dropped by 56.23% in the last 7 days. That's ridiculously volatile. I'm not saying it's not going to recover. Probably will to some extent. To what exact extent? How long will it take? I have no clue, nor do any of the people, quote unquote, investing, which again should be termed speculating in this, right? And this doesn't mean that Bitcoin, right? So last 7 days went up by 2.82%. Now, if you're looking at a longer time scale, let's look over here and let's put. I'm gonna let's look at the price here, and we're looking at year to date. So this is what has happened to the price of Bitcoin, right? We've seen this massive ramp up in price, but again, short term, it's very, very volatile. So don't buy cryptocurrencies with money you need for groceries, or with money you need to pay your rent on January 1st, right? If it's money that you need for long term and you don't mind the volatility, you don't mind the crazy price fluctuations, and remember, the previous high for Bitcoin was reached in December of 2017. So it took 3 whole years to match and then now beat that. So this looks like a W, right? Or at least a U, right? It took a whole 3 years for Bitcoin to retest those highs, and now it surpassed them. So it's impossible to know how high it will go before there will be some pullback, because eventually it'll have to have some pullback. Now, the good news is that most analysts, most people forecast that as long as Bitcoin maintains its importance in terms of being the main cryptocurrency, at least one of the main ones, if it no longer becomes the main one in X number of years from now, prices will stop fluctuating quite as ridiculously as they still are today. But it's not a guarantee, right? So, and same thing, let's look at Ripple, because since I showed you that. So here's Ripple. Okay, so same thing. The high, the peak, like with most cryptocurrencies, was reached in late 2017, early 2018. For Ripple as well. And again, the peak was around $3.20 US. Right now it's trading at, what was it? 26 cents, right? So it's far, far away from its peak. And the reason why I'm saying, if you're going to essentially gamble / speculate on cryptocurrencies, to stick with something like Bitcoin, even Ethereum, right? That has been the second largest cryptocurrencies for years and years and years and years. It's nowhere near its peak of 1,000 and what was it? About $1,500, $1,400. You see right around there, which was reached in January of 2018. Right, just a few weeks after the peak was reached for Bitcoin, whereas Bitcoin has finally surpassed that previous peak. So Bitcoin is really the driver. It's the main driver. And sure, the other ones, if you're putting $100 in some random one, and that $100 could eventually turn into 10,000. But I hope you realize that's really outright gambling, right? So that's just something to keep in mind. All right, so finally, if you're interested in something that is slightly higher risk, slightly higher performing, but that isn't quite as ridiculously volatile as cryptocurrencies, something of, again, interesting would be looking at something like the ARK Innovation. So this is your fourth link, I believe. So this is ARK Innovation ETF. So it's an ETF, so a little bit boring, but a lot less boring than a fully balanced and diversified portfolio, but also quite a bit higher risk. So again, this is not for everyone. I'll be reviewing their ARK Innovation ETF. So this is specifically the ARK Innovation one, but they have a few other ones. There's also the robotics one. I'm trying to remember there's a genomic one, the tech. I think it's the RQ, if memory serves. Yes, RQ is the technology and robotics ETF. So these are relatively new ETFs or newer ETFs. The robotics one is, again, it's only been around since since the beginning of, I think, end of 2019. So it's about 1 year old at this point. ARK case, so the innovation one, this one has been around for, I think, about 6 years, 5 years. Yeah, since 2014, exactly. So exactly 6 years and 3 months, I think, ago. And you see, initially it was quite low. Now, what tends to happen is during periods of upheavals, during crises, you literally see a lot of innovation. A lot of companies fail, especially the more traditional, service sector, restaurants. Unfortunately, a lot of people will lose their livelihoods with, prolonged lockdowns and what have you, which are unfortunately necessary. But there's also room for a lot of innovation. A lot of companies get created. A lot of new inventions come about at the height of crises, whether it's a war, whether it's a financial crisis, whether it's a pandemic. That's when innovation thrives. So looking at an ETF that, instead of just trying to guess which will be the next big sector or the next big company, you can still you can significantly reduce your risk by investing in an ETF that invests in tens of those particular companies. Again, it's still, this ETF, again, I want you to understand, is still higher risk than a balanced diversified portfolio. But if for you personally, you feel like a balanced diversified portfolio is a bit too mellow, you don't mind having a bit higher risk, you can supplement your balanced diversified portfolio. For instance, instead of investing in the entire US stock market, you can invest in this ETF, for example, or at least supplement your broad market exposure to the US with something like this. And again, I'll be reviewing all of the ARK Innovation and ARK other robotics and genomics portfolios, and the underlying portfolios of the ETFs in the coming weeks as well. So in short, for most people, balanced and diversified portfolio, especially when you're rebalancing once a year, short video about that tomorrow for Christmas. That's the way to go. But if that's a bit too mellow for you, you don't mind the higher risk, you understand the difference between investing, saving, and speculating / gambling, then it's okay. Try maybe 10% of your portfolio, or you can increase it a bit more if you really, really want to. Again, it's not recommended for most people, but there you go. So I hope I made this, you found this useful, and you'll be able to actually use some of this information for your own. Again, do your own research whenever you're looking at these things. It's important. So happy holidays, everyone. I will be, again, tomorrow, there will be a short video. And then next Thursday, on the 31st, I will give you another live stream. So I'll be here for New Year's Eve for, half an hour or thereabouts. So thanks for showing up today, and I hope you found this useful. See you soon. Have a great time, everyone, and happy holidays.